The Knight Frank Luxury Investment Index tracks passion assets the way a market index tracks stocks, and it reports that watches returned 125.1% over the past decade, a figure that sits ahead of art, handbags, and colored diamonds in the same rankings. That number sounds like a verdict. It sounds like proof that the steel sports watch on your wrist is quietly becoming a retirement fund. The broader 10-category index rose about 72.6% over the same stretch, so watches appear to have beaten the average of their own peer group by a wide margin. But there is something the headline does not say, and it is the difference between owning a watch and reading one. Here is what the catalog omits. The 125.1% belongs to a narrow slice of the market. Steel sport models, discontinued references, limited editions from the top 3 houses. Rolex, Patek Philippe, and Audemars Piguet averaged 20% annual appreciation from 2018 to 2023, according to one 2026 investment guide. That is a spectacular run. But those 3 brands are the exception that defines the rule. The visible world of luxury watches is built on the auction hammer. You picture the room at Geneva, the paddles rising, the lot number glowing on a screen. You imagine the collector in the front row who buys the reference everyone else covets, and you assume the same logic applies to every box in every boutique window. It does not. The guides that track this market are careful to say that investment-grade pieces are a narrow segment concentrated in specific brands, specific models, and specific conditions. Most watches are not investments. The bluntest summary from a 2026 guide is 3 words: most are not. The longer version from another analysis of the same data is barely longer. A few are. Most are not. If you have ever scrolled through auction results late at night with the room silent and your heart tracking the hammer, you already know the difference between buying a watch and betting on one. But the numbers underneath that feeling are stranger than the feeling itself. That strangeness is the door we walk through together. Subscribe to stay with me as we uncover the invisible truth behind every watch, one layer at a time. In the comments, share a moment when you felt the difference between buying a watch and betting on one, something the auction catalog would never capture. Here is the contradiction that upsets everything. The watch market's volatility, 3.9% annually, is the lowest of any asset class examined in a study that ran from January 2019 to September 2024. Fixed income, the closest risk peer, sits at 5 to 8% volatility. Real estate and equities move more, so a luxury watch as an asset is calmer than a government bond. That is the kind of phrase that sounds reassuring until you ask what it returns. The same EHL analysis that reported the low volatility also reported the annual return. Luxury watches, as a whole, showed 5.68% per year. That sits below US stocks, which returned 12.85% in the same comparison, and below gold. It sits above fixed income and real estate, so the asset that barely moves also barely grows. The seduction of the 125.1% headline and the reality of 5.68% are 2 different currencies. The watch on your wrist costs more than the phone in your pocket and keeps worse time. That is not an accident. The balance wheel inside beats 28,800 times per hour without a battery, without a chip, without a single wire. A quartz movement would be 10 times more accurate for a fraction of the cost. The mechanical heartbeat is the difference between a tool and a companion, but it is also the reason the investment story gets complicated. Why would a watch worth $500,000 lose money year after year, while a steel sports model from 2005 triples in value? That is the contradiction question this entire world hides behind a display case. The answer begins with the difference between the market and the asset. The market is a spread that is enormous. The broader market includes many depreciating pieces that lose value quietly, without a headline, without a mention in any index. When Knight Frank compiles its luxury investment index, it is tracking the winners. The index is a benchmark for passion assets, and watches are included among the tracked categories. But an index is a selection, not a census. The 125.1% decade return reflects the pieces that appreciated enough to be counted. The thousands of watches that never hit the block, the references that slipped below their original price, the condition issues that halved a value, those do not make the index. You have probably met someone who treats their Submariner like a treasury bond. You have met others who still check the time on their phone. You are neither. You want to know why the discrepancy exists, why one reference climbs while another decays. The spread inside the asset class is the real story. In that EHL comparison, the entire category averaged 5.68% annually. But the top brands, Rolex, Patek Philippe, and Audemars Piguet, averaged 20% annual appreciation from 2018 to 2023. The gap between 20% and 5.68 is not a rounding error. It is a chasm. Subscribe if you are ready to look beyond the index headlines and into the mechanics of lasting value. In the comments, tell me about a reference you have held or hunted where that spread became real. Just type chasm if you have felt the discrepancy in your own collection. The gap between 20 and 5.68 is not a rounding error. It is a chasm. It means the index is being dragged upward by a tiny elite, while the majority of the market contributes almost nothing. The 20% figure is the buried figure this industry prefers not to discuss because it reveals how few pieces actually deliver the dream. When a 2025 paper in the International Journal for Multidisciplinary Research examined the Indian market, it found collectible luxury watches showing roughly 9 to 10% compound annual growth with reduced volatility. That is real appreciation. That is also a specific market, a specific segment, and a specific kind of collector. You expect a diamond. What you find is a minefield with one golden island. The visible narrative, buy a luxury watch, watch it appreciate, is the decoy. The invisible truth is that the only reliable appreciation lives in a narrow corridor of scarcity, provenance, and condition. The study's findings suggest that high-end timepieces could be an attractive option for investors looking to diversify their portfolios because they have a low correlation with the stock market. That is the qualified, honest version. It is not a promise of wealth. It is an invitation to rethink what the watch is for. The collector who sees only the price graph buys the wrong watch at every turning point. The collector who reads the volatility spread buys one watch that outlasts a bear market. The real asset was never the metal. It is the hand-finished caliber beneath the dial, the anglage edges that catch the light only at a specific angle, the Code de Genève stripes that run parallel under a lup, the guilloche pattern that took hours to cut into the dial. That is the invisible world. The movement is where the value actually lives, and it is also where the investment thesis breaks cleanly. A watch produces no yield. It pays no dividend, issues no coupon, generates no income while it sits in your safe. The guide that listed Rolex, Patek Philippe, and Audemars Piguet as the best performing brands also noted explicitly that watches produce no yield. As a core investment, they do not function. They are a store of value at best, a diversifier at their most useful. That last phrase, portfolio diversifier, is the honest place where the investment story lands. Many luxury watches should be treated as a portfolio diversifier, not a primary investment vehicle. The volatility data supports it. The low correlation with the stock market supports it. The 5.68% annual return does not support the illusion of growth. The 125.1% decade figure is the outlier, the exception, the headline that sells magazines and opens wallets. The market will correct. Trends will shift. The stainless steel sports watch that tripled in 5 years may plateau. The limited edition that seemed guaranteed may become ordinary. What does not change is the heartbeat inside the case. The balance wheel that never needed a quarterly report. The mainspring that stores energy for 40 hours and releases it in a controlled, silent unwind. The mechanical soul of the watch is the only constant, and it is not priced into any index. In the next chapter, we open the atelier door on the one material even the greatest watchmakers refuse to promise as an investment: the alloy that oxidizes, the dial that patinas, the surface that records time visually. That is where the invisible world becomes visible, and where the collector who reads the movement finds a different kind of return. The heartbeat inside the case never asked to be an index fund. You have been reading the movement, not the price tag. Subscribe to walk through the atelier door with us next, where patina becomes the truest return. Comment century below if the century on the dial means more to you than the quarterly report. Then there is the question of what you are actually collecting. If you bought for the investment illusion, you bought the wrong reason. There is a richer path. The dial shows you a price. The movement shows you a century. Which one have you been reading? The answer changes what you look for at the next auction, and it changes what you feel when you wind the crown in the morning. The last layer is the legacy. A watch that sits in a safe for 10 years and gains 13% is a financial event. A watch that moves from one wrist to another across 2 generations, carrying its provenance like a watermark, is a custodianship. The current owner is a custodian. The watch belongs to the person who will inherit it 60 years from now. That relationship is not in the index because it cannot be priced. Let me tell you what the numbers cannot. There is a reason the guide said most watches are not investments, and the reason is not financial. It is structural. The majority of luxury watches are produced to be worn, admired, serviced, and passed on, not to be flipped. The factory does not design for resale value. It designs for the moment the crown is pulled, the time is set, and the wearer looks down at a dial that was finished by human hands. You can feel the difference when you pick one up. The case cools against your wrist in the morning. The crown slides under your thumb with a certain resistance, not too loose, not too tight. The rotor spins silently when you move your arm. These are tactile realities that no spreadsheet captures. And they are the reason a watch that loses 10% of its value over 5 years can still be worth every cent you paid. The question in the title, investment or illusion, resolves into an answer that is neither satisfying nor simple. For most, the purchase is an illusion of investment, a story told by the display case. For the knowledgeable few, it is a genuine diversifier, a low volatility store of value with a low correlation to equities. But the true return, the one that never appears in any index, is the quiet pact between the craftsman who finished the movement and the owner who winds it. The second hand sweeps without a tremor. That is the pact. Silent, mechanical, utterly indifferent to the market.